Sure, that's fine. I've been doing financial projections and business planning probably since last century in a variety of contexts, both within Fortune 500 company, in startup companies, and as a consultant, both with other companies and with my own shingle. I have also been teaching up at Cal State Fullerton for a number of years, and before that, taught at Concordia. Academic background, I actually have a degree in finance, so I understand some of this stuff. But let's start out. You've got this nice little cartoon here, which is really true. I have seen a lot of business plans and a lot of financial models that don't make a lot of sense. And I want to try and help you make sure that the ones that you put together are believable and defensible. So let's get going. And this is the to our sponsors. I didn't have the Startup Incubator one, but it's close. So thank you, JJ and Philip and Travis. So really three key points at this point. In order to make a believable plan, you need to gather data. The data that you can't get, you need to make some sound assumptions, and then you use that data to build a financial model from the bottom up. So let's see how we can do that. And I do have the chat open to make sure I can get it in the right place so it's not. Yes, if I put this over here, does that block the screen? Are you seeing just the screen, or are you seeing the screen?
You're good. You're good.
Okay. That way I can have more on my screen, and I'll have all of the people here on chat over or on the online over here, and that will help me maximize my resources. Okay, so let's start. So first thing, you can obviously do primary research. Primary research is really, it's useful. But it's also typically very time consuming. It's things like focus groups, questionnaires, going and asking people who are in trade associations, the type of long interview questions that JJ talks about. Those are all primary research. Secondary research are things like census data, Google competitors, IBIS World, what is that? RMA studies. All of these are things that are external sources that can give you good data on markets, costs, and a variety of other things. But what you want to do is you want to be able to tell your story. And the way I like to tell the story is I will typically start with, okay, it's just slow. Typically start with the things that are external that I can't change. Things like, what does the industry look like? What are the market trends? How big is the market? What are the demographics? What are the buying criteria? Who's your competition? Are they better or worse than you are? What's your differentiation? Do you have IP? All of those aspects to the business are important to telling the story. And they are all external data. So you should be able to provide not only the data, but also sources of where you got that data. One of my favorite ways in which to get data is to, it's just slow. I'll need to work on that. Is long search terms in Google. Just as an example, if you wanted to open up a retail florist shop in Costa Mesa, you could use Google Maps and it would show you where all of the florist shops were. And if I did a Google search, you can see this was retail florist, Costa Mesa, California. You can see that there within that triangle and maybe down in the lower right-hand corner or lower left-hand corner, you might be able to find some space because again, florist shops tend to be pretty local. People don't go very far. So you want to find a geographic space that is convenient. It'll also tell you, things like hours, what they are, how they differentiate themselves, some of the ratings, so you can get an idea again of who your competitors are. One of the key things that's often overlooked is that every trade and industry has both trade associations as well as trade shows. So if you're in the retail florist industry, you go to the Society of American Florists, and they, as you can see, let's see, about 6 months ago, they had their annual convention in Phoenix. If you're students, you can go to these pretty cheaply. In most cases, if you're not, the exhibit halls are often low cost or free, and go in there. And it's a wonderful way to get information about the industry, especially if you don't know a lot about the industry. The other thing is that many of these associations have local affiliates. So just like there's a Society of a national group, there may be a California group and maybe even a county or city group. And you have to realize that the people who are involved in these groups, the executive director gets paid to do it. The president and the other officers are in it because they love the industry and they want to give back, so that you can get a lot of information from these people by just being kind to them, taking them out to lunch, and letting them tell you about their favorite subject, which is the industry that they work in. So again, it's a way of ramping up your knowledge about an industry very quickly. One of the other ways in which you can get lots of data is to go to the government and also RMA, Risk Management Association. Most of the businesses, or in fact, all of the businesses in the US have a code, an NAICS code. And if I were doing this in class, I'd say, does anybody know what that is? But I'll go ahead and just tell you. It's the North American Industrial Classification System. And it turns out that the government and a number of other people keep statistics. You can see IBIS World. There's also the Economic Survey. They have information that is available for this industry. So again, if you're looking at is this a fragmented industry, growing, shrinking, who are the big players? All of that is available, and you should have that information as you begin to tell your story. I will say that let's do this. If anybody has any questions, I will try and watch the chat, or if you just want to go ahead and unmute and interrupt, that will be fine as well. So what's the bottom line of data? The bottom line of data is get third-party verifiable data. Because what does that do? What it does is it when you're dealing with an investor or a banker, and either debt or equity source of funding, if you can provide third-party verifiable data, then it is not your opinion or versus their opinion as to what's good, bad, or indifferent. But if you can agree that, yes, this is a credible source, and we can agree that this is good data, we can then move on from there. So, number one, get good data. Don't estimate it if you can help it. And I will say, though, there are times when you sometimes may have to use a proxy, and that's okay, so long as it is something that's reasonable. If you wanted to make an app, say, and needed to know how many apps could I sell? Well, a good proxy is that how many phones are there? And that would be the maximum number of apps you could sell if you were to have your app on every phone. But let's go to point 2, which is the financial model itself. And I apologize if some of you have are experienced in accounting, but this assumes basically not a whole lot of prior knowledge. So we're going to look at the financial model. I typically like to do a bottom-up financial model where I can add the numbers together as opposed to top-down. I typically like to do it month by month because if you try and do it annually or quarterly, sometimes there are significant cash flow issues that you have to deal with. And again, if you know anything about financial statements, these 3 statements link together. And I typically will use a spreadsheet that has them linked together, because unless you are really an expert at spreadsheets, it's very difficult to link these 3 together and make sure that they are all in sync. So there are some very good ones out there. I've got good ones. Score has a really one that's about, I'll say 80 to 90% out there. So that's very good. So again, we start typically with the income statement. This is your pretty typical income statement. Sales minus cost of goods sold is the gross profit. Gross profit is a good indication of whether you're going to make money or not. Various industries have different levels of gross profit that are standard. Again, you can go to things like the RMA studies or industry studies to say what the typical gross profit is. And as an example, in a retail store, the typical gross profit is $1 for every $2 in sales. So you buy it for $1, which is your cost of goods sold. You sell it for $2, so your gross profit is $1, and that has to cover all of your expenses, rent, salaries, etc. Let's see. So, in a believable financial plan, sales forecasting obviously is where you start up at the top line. But it's certainly one of the most difficult areas, because how do you forecast sales for a business that isn't up and running? You know, if you're in business, you can look at historicals and say, how much am I going to grow? But if you've got nothing, no history, how do you do it? Well, that's one of the things we want to talk about today, is how to do forecasting when you don't have any prior history. So this is an example that I used from a student of mine. They said what they wanted to do was repair a certain type of car in the Middle East. And they said, okay, you know, they could get data that said 84% of the cars, got good data, verifiable, that said 24% were imports. That gave them sort of a total addressable market of a little over 20,000 cars. And they said, okay, well, the average repair bill, again, from a third-party source, is just under $500. So what's our total market? Well, we could make $9 million. And you know, if we only got 10% of that market, we'd be doing really well. We'd have $1 million business. Now, does anybody know, I mean, is that a reasonable way to do it? Or are there flaws that you could point out with this? And if you see any, go ahead and unmute and let us know. One of the hazards of teaching in Zoom land, you can't stare at someone and let's, you know, and make them answer. But what do you, the problem that I see with this is that this is all really good data, but this one here, this estimated market that we can get 10% is really the killer to this whole deal, because I don't know how they don't explain how they're going to get that 10% market. That's a swag without any basis and therefore it's not terribly believable. Someone could punch a hole in it really easily, and we want to avoid that. So I'll say there's about 5 or 6 different scenarios where you can forecast your sales. Let's go through them one by one. One is where you have capacity utilization. And this can be, I've got a restaurant that has a certain number of seats. I have an education building that has a school that has a certain number of seats. I have an airplane, a bus. I have a certain number of, I can only produce so many kilowatt hours. Anything that has a capacity, you can forecast using a capacity utilization model. And in this case, we'll look at a restaurant. The restaurant in this case, and again, Philip asked me about these because these slides actually contain links to live spreadsheets that are embedded. And if people want to play around with them, they can. But if you've got a restaurant, you can make some assumptions that are reasonable about what you're planning. It's management's decision as to what the hours are. It's management's decision as to what the actual physical seating capacity is, in this case 40. You can make an assumption, a reasonable one, based on the industry as to how quickly your tables will turn, meaning in this case that the average guest will stay at a given table for an hour and a half. And again, based upon the type of business, you can make an estimate as to what percentage might be takeout. And again, industry averages and your menu, what your average check is. So these are all pretty good numbers. And then what you do is you go through and say, okay, for any given time slot, how much of my seating is going to be taken up? This is a little bit less. You don't have exactly the same level of data precision, but you can make some pretty good assumptions here, reasonable ones. We know that in this case, dinner is going to be busier than lunch, and there's a lull in the afternoon from 1 to 5. People typically don't go into the restaurant and eat. You can also, if you really wanted to, you could go do some field research and go to a similar restaurant and see what percentage of their seats are empty at given hours and use that as your source. Do some, again, going back to that first source of data, the field research, go and count it. I mean, if you think about it, most fast food restaurants are empty probably 90% of the time because they are set up to handle a large influx of people at one time. So they have lots of excess capacity. And if we do the math here to say, okay, how much are we utilizing? What's our effective capacity? We can do the math and come out with annual sales. What I would then do typically is there are sites on the internet that says, okay, for a given type of restaurant, this is a typical sales volume. So I think the typical McDonald's franchise, say, does $1 million, $1.5 million these days. So this might be reasonable for sort of a mom and pop type of store to do 750,000 a year. Philip, you had a question? Estimated. Oh, okay. This one must have been from a while ago. Estimated market share. Yeah, you're right. That was indeed the killer in that one. So this is capacity utilization. If you are a manufacturer of something that you are selling, let's say in this case we are selling candles or making candles for distribution. What we can do is this: we can say, okay, we sell one candle at a time. The retail price is $2.50. We know that the retail markup is 100%. We're going to sell these in cases of 12. So the wholesale price is 12 times $1.25. So is that right? Is that right? Yeah, $1.25. So that's $15 a case. The wholesaler this may be a little high, maybe not, but it basically says that as a manufacturer, we're going to be getting $12.50 or $1 per candle. So that's our revenue, is that dollar per candle. But what we're going to do is we're say, okay, how wide is our distribution network? And while this is a static model, if I were modeling this in Excel, I would have these three numbers, vary on a monthly basis. Meaning, okay, what's the average sale per store? And then either a unified number of how many number of stores, or if we're going through a chain or other distributor, which is what this says, is that, okay, we've got 12 retailers. Each retailer has 5 stores, and we're selling 7 candles a week or 1 a day in each of those stores. And again, if we do the math, we'll come up with our annual revenue is $270,000 based on $1 per candle. Again, most of this is you can get externally. The sales forecast, this is a little bit more from your management viewpoint. But one of the nice things is that if you can identify these numbers, the number of stores, the number of retailers, and the average sales, you can actually track that number. And once you begin selling, you can get feedback on your estimates and say, how close did we come? And therefore, you can refine your forecasting model because you've done it right from the bottom up to begin with. It's not, we're going to pick a number at random. We've got a baseline, and are we above, below, or at that baseline number of, in this case, 1 candle a day for each of 60 stores. Now, on the other hand, what if we're the store that's selling the candles? Well, I wanted to vary it a little bit. In this case, it's a sort of a combination of or a variation, if you will, on the retail capacity. Because one of the things that, well, again, if I were asking, I will, so indicate how many of you have ever walked into a store and not bought anything?
Definitely.
You can use your hands, say hello, something like that. Yeah, okay, most of us. So if we are in retail sales, it's, we have to be open in order for somebody to buy the product. And in this case, we're looking at just we're saying that 25% of the people who come in the door actually buy something. Their average purchase price is $75. And this is a count of how many people come in the door. Again, if you want to do some field research, you can go to a similar store at your neighborhood mall and count the people coming in and out of the store for a couple of hours. Maybe if you count it for a day, 1 day on a weekday, 1 day on a weekend, you then have, while not a large data set, you have at least one set of data points that say, okay, this is the sort of traffic I would expect in my store because it's similar to store XYZ. And I sat there for 8 hours counting people going in and out the door, which in most cases will at least get you props for doing that level of research. So again, we do the math. of how many people are coming in and out the door. We have a 25% conversion rate and a $75 purchase. So we can look at the weekly sales and the annual sales, and 2 million for a business that has an average ticket. This is maybe a clothing store, shoe store, something like that. An average purchase price of 75 doesn't seem bad.
Hey, Tom, you got a question from Jacob, it looks like.
Okay. Okay, go if you want to go ahead and unmute, or are you just saying that? Yeah, unmute and ask. Jacob, or you is
Oh,
this
sorry.
is
No, I don't have a question. I
oh
just put a thumbs up for the.
that's a thumbs up for yes, you had okay, got it.
Yeah, yes, I had for the
Okay,
previous question.
yeah, okay, thank you, sir. Okay. So, but brick and mortar is not the greatest thing these days. A lot of us will do e-commerce. Well, how do you do e-commerce? Again, it's a matter of tracking how you get people there. In this case, there are two ways to get people to your site. One is by paid advertising and the other is by organic advertising. This again is a pretty simple model. If you could also put in here SEO costs, but we'll assume that you'll have a Google AdWord budget of $100 a day, and you're going to pay 15 cents per click for every click through. And we're going to say 40% of your visitors are paid, the other 60 are organic. Again, you can vary these numbers and the model will do the math for you. I haven't looked at the data recently. This was it may be a little bit higher these days, but I was going off the assumption that the number of people actually will start something on your site is about 2 in 100, because that's about the same rate that you will get from a direct mail advertiser. Now, and I should actually look at that and verify, but one of the key things that sort of a hidden secret of e-commerce is this 70% transaction or abandonment has been pretty consistent for a number of years. I won't ask you because I think I know the answer. How many of you have ever abandoned a shopping cart? And then, of course, been retargeted by that company because now they want you to complete the cart. Yes, I think most of us have. So we'll assume that of the people that start a cart, 70% abandon it. But we've got a good site where we charge $80 for whatever we're selling on the site. So if it's costing us, $100 a day, we'll get 600 paid visitors. That means we'll get about about time and a half. Total visitors, 2.5 times for total visitors. Very few of them will start a cart. Most of them will abandon it. But even at this low checkout rate of 10 customers a day out of 1,600 visitors, if our average purchase is $80, our cost of customer acquisition is $100. And again, if you have SEO costs, you could factor that in as well. But the cost of customer acquisition is $10 on an $80 purchase price. That's pretty reasonable. Again, what you want to do is you look at what I'll call sort of the smell test. Is do the numbers seem to fit together? And yes, a cost of customer acquisition, 10 to 12% of your initial purchase is probably not a bad number. So it meets the smell test. Now, what's nice though is that this is for the first purchase only. If you have something that they're going to buy over and over again, you go to the second phase of it, which is, if we go back, we had, this is a daily number. So we'll have 30 people a month checking out. And if we say they're going to purchase our product every 3 months, and 95% of them will purchase again. Again, this is pretty easy to do in Excel, this sort of, tiered math, where you say, okay, what's my repeat purchase is basically a percentage and an offset from my initial purchases or my total purchases. And therefore, what it says is that, again, given these parameters, the average customer is going to buy from us 19 times. So the lifetime value of that customer shoots up to $1,500, and we got them for 10. So that's really a very, very good investment. There are some things, however, that are big enough or new enough where you need to have that face-to-face interaction. Usually if it's a very large purchase, or if you're selling something business to business, you have a different sales funnel. Again, the whole key thing of this is to model the sales funnel. Here I'm going to model a sales funnel that is primarily based upon a trade show. Just to give you some example that, yeah, it can be pretty complex, but again, so long as you can identify the assumptions and put them into a spreadsheet where if you're talking with someone and they don't like the assumption, you can put in a different number and see what it does. So in this case, we're saying, okay, we're going to be at a trade show, and we're going to be there 12 hours a day for 3 days. We're going to have 2 people there, and it's going to take us 5 minutes to get a lead. So if we do the math, we're going to come home with 800 leads, but it's cost us, the booth and the collateral and the hotel and the meals, et cetera, et cetera. And maybe that needs to be updated, but again, the math is, you can update the numbers and the math will flow through, because again, these are live spreadsheets. The cost for that lead is $15. Then what we do is we go back to our home, our office, and say, okay, we have to qualify these leads. Qualifying takes a 15-minute phone call, and we're going to pay the salesperson $40 an hour to do this. Turns out only 20% are qualified. So what that means is we've now cut our population down to 172 qualified leads, but and the cost for those qualified leads has gone up. So what do we do with the qualified leads? Well, we prepare a proposal, and it takes an hour, but maybe we're only going to prepare it for 40% of those, because we've got a sense that maybe some of them really are not as interested as we think. So we're going to prepare 60 or 70 proposals. And what that means is that for each proposal, the cost per proposal goes up. We're going to some of them are going to order. 60% of the proposals are going to say yes. So we're going to get 40 orders, take some time to process the order, and therefore our cost of that customer acquisition, after we've gone through the qualifying the leads, putting together a proposal, and accepting the order, is $600. So we need to make sure, or 619, pardon me. We have to make sure that whatever we're selling, is commensurate with that $700 cost of customer acquisition. The last one is one that you will typically rarely see. But if any of you should ask, any of you still carry around a flip phone? Probably not. And my guess is most of you don't have, if you have a TV, you probably don't have a black and white TV. So, and if you buy music, you probably buy it digitally, as opposed to having CDs or cassettes. Now, some collectors may still have vinyl, but the whole idea of this is that there are some technologies that are so innovative, such as the smartphone, the color TV, and different methods of distributing music that they completely wipe out the prior technology and nobody uses them anymore. An example of this, actually, I'll argue, is if anybody knows Brian Roof and 108 Systems, I will argue that his is an innovative product that will follow this, and at some point, radio dispatch will be as prevalent as 8-track tapes. Now, anybody ever have statistics? Or maybe have some of you seen this curve? My guess is most of you have. This is the standard distribution. And if you understand it, you have these innovators and early adopters and so on. A couple of things here that are interesting to note. The primary buying criteria of the late majority has nothing to do with price or need, but is primarily a psychological purchase. And their buying criteria is that if half the people I know already have it, then I should buy it too, because I don't want to be left in the dust. So it's a very much a Me Too purchase criteria, purchase mentality. And again, one of the things to realize that this is linear over time. So things like advertising, if you do broad-based advertising, it's pretty useless because the only people who will buy a new innovative product are these innovators, these 2.5%. So the others will see your ads and say, "Yeah, it's too new. I don't know anything about it," and dismiss it. What's nice though is that if you are a statistician, you can actually estimate the area under the curve. And in fact, I did this for one of my clients more years ago than I care to think about. It was 2012. And in 2012, the smartphone had been out for about half a year, about 5 years. And they were selling about half of the phones that were being sold were smartphones. So we did an estimate and said, okay, that means we're probably about here in the curve. That means that the time from time 0 to here was 5 years. So we're going to say this sigma amount. So if that was 60 months, I think we said the sigma was about maybe 18 to 20 months, maybe 24 months, something like that. And what you can do is if you slice up this curve and say, okay, I've got this little portion here, this 1/60th of the curve, and I know the total addressable market, which is the area under the curve. And then in our case, we use the total population or close to the total population of the country, because we figured that everybody over 6 years old would have a smell phone. And what that does is that allowed us to estimate what our sales would be. Yes, yeah, thank you. I believe I actually met Mr. Rogers, and not that one, but Mr. Everett Rogers. And if you don't know, this whole thing dates back to his PhD thesis, which he did in the late 50s on he was doing it on a new type of seed, but this actually came out of his review of the literature, and he found this pattern that no matter what sort of new technology came out, it always followed this adoption curve because it's primarily a psychological buy and not a technological buy. Yeah, fascinating stuff, but yeah, you have to be really in a specialized niche to be able to use this. what's next in the story? Well, if the sales are the sort of top line, the costs are the next part of the line. Cost of goods sold, how much is this going to cost for us to make? You should have a really good idea based upon either bill of materials or contracting with a manufacturer or some such thing as that will let you know what your costs of goods sold are. Again, third-party data. You can make some estimates as to what your SG&A are based upon things like how many people are you going to have? What's the rent? How much are you going to spend on insurance? Again, sometimes you can get quotes. Sometimes you can make estimates. Sometimes you can go to sort of industry standards. But again, so long as it's not a swag, but a number that you can say, this is where I got it from, it increases the credibility. Now, people are an interesting thing. We have to pay people. So how much do we pay the people? Well, the government is our friend in this case because there's something, especially in California, there's something called the occupational wage survey, and it will tell you every year they put out this number saying, in this particular county, how many workers are there in this category? What do we pay them? And the SOC, the standard occupational qualification, another good data source, good government number to say, well, what does a restaurant cook do as opposed to a short order cook? And in fact, the government will help you determine, based upon what these people do and what you expect your people to do, which category that would fall in. So that's the wages. But then what you have to do is you have to add on to those wages. You have to add on unemployment, because indeed you have to, if a business has to pay unemployment. These are the current rates. They've been that way for a while. In addition to that, you have to pay the employer portion of Medicare and Medicaid. And actually, I did not update it. I apologize. I think the current limit is about 170 or 180. But there's still more. As an employer, you have to pay for workman's comp. I'm going to assume that I don't have to explain what workman's comp is, but workman's comp can be messy and it can also be simple. It sort of depends. There's two sources of data for workman's comp. One is the Workman's Comp Insurance Review Board, or the WCIRB, and it will tell you which code to use. In this case, if we are using a restaurant, everybody from the server to the entertainers are all in the same classification. In other companies, the salespeople, the outside salespeople may be at one rate, the desk workers may be at another, factory workers at a third, and I could tell you some stories about that, but I want to make sure we get through within the hour that we have allocated. But this will get you the code. Then what you do is you go to the second source of data, which is the California Insurance Board, Insurance Commissioner, and they publish the rates. And I typically go for the State Compensation Insurance Fund because that's the insurer of last resort here in California. I believe they are by law required to issue you insurance. So again, for this particular industry code, you're going to pay basically $4 out of every 100 for workman's comp. Now, some industries are more, some industries are less, but as with all these other costs, if you add up all these payroll costs, it adds up to between 15 and 20%. And if you had forgotten to put those in and maybe had a very labor-intensive business, you could think you're doing okay, but you hadn't got all your costs in, so you're not really doing as well as you think you did. So that's, we can find out pretty easily how we pay people, and and we can make some assumptions about when we're going to hire and who we're going to hire. The last thing is we look at the balance sheet and say, well, okay, where are we going to get cash from, and where is it going to go to? Cash is king, certainly. We have to understand that the only two things cash can be used for is, first is it's buying something else. If you buy equipment, if you buy a building, if you buy inventory, if you buy any other asset, what you're doing is you're trading off a cash asset for a non-cash asset. That's in the long-term assets, the fixed assets, as well as inventory. No. So working capital, actually, it's not inventory. I take that one back. What we call working capital is made up of two things. One is if you sell on account, you're basically acting as a bank, and you have to have money, working capital, to support both the accounts receivable as well as the inventory that you're using. Now, on the other hand, you may get a little bit of leeway if you can push your payables out. And in fact, one famous story is that one of the ways that Nolan Bushnell got his start is that he went to his customers and said, went to his customers, his accounts receivable, and said, I want to get paid in, not in 30 days, because I'm a poor entrepreneur. I need my money fast. And then he went to his vendors who he was buying his inventory from and said, hey, I'm a poor startup. I'd like you to, if you could give me 90-day terms instead of your normal 30. And they said yes. And he was able to use his cash flow to help build his business. But understanding those three things, are you going to sell on credit? How much inventory do you need? And when do you have to pay for that inventory? Are all key things, because this is why you do a statement of cash flows, is because if you don't have that, you can actually grow yourself into bankruptcy if you don't have enough working capital, or all of your profits are tied up in inventory that you can't sell. The last thing about a believable plan is you have to know what you're asking for. Are you asking for debt money? Are you asking for equity money? What's that money used for? And because depending on the source of those, or the use of those funds, you could go to different sources. If I were buying equipment, I might go to an equipment financing company such as GE. If I'm going to be using it for marketing, I'm going to have to sell. No one is going to lend me money to use for marketing. There, I'm going to have to go to investors, equity sources. Going back to our friend Bushnell, it's important to understand the industry standard payment terms. One of them is we'll call prepayments. If any of you have gone on a cruise or taken an air flight, normally they get their money way in advance of when you actually travel. So oftentimes they don't have cash flow issues. They just need to make sure that they have the cash still in hand when indeed you want to board the boat or board the airplane. So those are prepayments. You have what is called coincidental payments, meaning they happen at the same time. And what this is that this is why a retailer typically has very little in terms of accounts receivable, because when they sell something, they'll either get cash, which is immediate, or they'll get a credit card, and usually that's maybe a payment term of 2 or 3 days, depending on how quickly it turns. So they have very little in terms of accounts receivable, if any. Then you have big companies, if they're selling a big computer system, if they're selling manufacturing equipment, it may indeed take a long time to put in, and you may end up selling things on terms And you have to realize that if most people say they would like payment in net 30, the actual payment history typically is about net 45. And the last thing I'll talk about is inventory management, which is when do I need to pay for stuff? Just like people will try and push you out to 45 days, you in turn can either be a good guy and pay your vendors in 30 days or push them out to 40, 60, or 90 like Walmart does. So the key things here, again, go from data. If you don't have data, make reasonable assumptions and document your assumptions. That's number 2. Build it from the bottom up so that you can then also track your numbers so that this isn't just a financial model for raising money. It's also a financial model that you can use to track your actuals as you begin buying, selling, and doing stuff. And I think I have all of 2 minutes if anybody has any questions.